This video, you're gonna learn how to create a universal life illustration using IA Financial EVO software. So what you're gonna do is you're gonna go to the EVO life insurance software online. If you don't have access to that yet, I'm gonna show you that you're gonna have to go to your advisor center with IA. Right? So if you don't have access to Advisor Center yet, then you need to create access. Now, you're gonna go to EVO. So you're gonna click here where it says EVO, and then you're gonna find, Streamline Insurance and Simplified Savings. So you're gonna, under Streamline Insurance, you're gonna launch EVO, and that will open the illustration software. Now, what you can do to make things easier, here you can actually, if you click on this start, it's gonna actually add it as a bookmark to your Google or browser, whichever browser you're using. I recommend using Google Chrome, right? So like if basically if I close that, then you can see I have that EVO Live as my tab here. And if I click there, so when you open the EVO illustration software, then you're gonna see here, you're gonna see all the products available through IA, right? So you have traditional insurance, universal life, simplified issue, critical illness, and then you also have some concepts. In this case, we're gonna focus on universal life insurance, and this illustration is gonna be YRT. Now, when you see here, you have basically, your types of insurance types. So the universal life for industrial alliance is called Genesis. And then you have three types of insurance cost: YRT, level, and level with quick pay option. So YRT means yearly renewable term. So that means that cost of insurance increases with time. Level, it means it's always the same cost, right? And then you have level with a quick pay option as well. Now, in this case, we're going to focus on yearly renewable term. So if you click on yearly renewable term, it's going to open, right, your illustration tool. The first thing we want to do here is we want to select the client details. So if you click there on client one, then you're going to put all the details from the client. So let's say my client is Bart Simpson. So I'm going to put here last name. I'm going to put first name, right? And then on the date of birth, you want to actually put the date of birth instead of putting the age. So I'm just going to make up a date of birth. Let's say it's, let's say the client is 45 years old, right? He was born in 1981. And then you're going to select the gender. In my case, is male. And then if there's tobacco use, I'm going to put no. And then we're going to apply. Now, this is the insured. And then on the bottom, you're going to see that it says applicant. So applicant refers to the owner of the policy. So the applicant and the insured can be two different people, right? So for example, if this was, let's say, a policy for a child, maybe the child is the life insured, but maybe the parent is the owner. So if the owner was different, then you will need to change it here, right? In this case, we're going to assume that the same insured is the same owner, so I'm going to leave it like that. Right, you could also add more than one applicant if it was going to be a joint policy, and then you would click here, add a second applicant, right? Or if instead of an insured, this was a corporate policy, then maybe you would put the business name here, right? So if it was, let's say, for example, an insurance under a corporation. Now, the next thing you want to do here is you want to change the province where your client is located, right? So let's say here it says Ontario, that's my default. But if it's in a different province, then you just gotta come here and change the province, right? So let's say, for example, if this client is in Alberta, we're gonna select Alberta. Now, then you're gonna go here where it says, death benefit. This is where we're gonna start selecting our coverages. Where it says here AOFA, that it means automatic optimization of face amount. You want to have that box checked all the time. The reason why is what this assumes is if the fund value in the policy exceeds the tax exempt limit, then the insurance company will automatically increase the death benefit to the maximum allowed limit to keep the fund value tax exempt, right? So you want to make sure that that's always checked. Then here, and then on death benefit, you have three different options. You have face amount only. Face amount only means that the death benefit will stay level, right? So it's always going to be a level death benefit, unless they have to increase the face amount because of the AOFA. Then face amount plus fund, what that means is as you start growing the fund value in the policy, that fund value gets added to the face amount, as a death benefit, right? So like your death benefit will increase with time as the fund value increases as well. And then you have face amount plus fund with wealth maximizer option. We will cover that in a different video, but in this case, we're gonna select face amount only, right? So let's say I want $100,000 of universal life, then I'm gonna put that there under amount. And then you want to add any other coverages that you want to have in the plan. So you see here on the bottom, it says add coverage rider. So if you click there, it's going to open on the left side all the riders that are available through this plan. So let's say, for example, I want to term 20, then I'm going to click there. And you see here, it's going to add here, my term 20. Let's say I want $400,000 of term 20. And that would make basically my total face amount $500,000. 100,000 universal life, 400,000 term 20. Now, very important here where it says projection period, you want to adjust this projection period to the term length. So if I selected a term 20, I'm gonna probably select here 20 years. Right? You want to do that because if you leave the projection period, let's say here it tells you projection period can be between 20 and 40 years. If you leave it at the maximum 40 years, the software will assume that your term would automatically renew after 20 years. And when you try to calculate premium, the premium might seem very expensive. Right? So you want to make sure that this projection period matches your term. Now, let's say if I wanted to also add some critical illness, I'm going to put, let's say here, a term 20 critical illness. And let's say we need $50,000. I'm going to put that there. And same thing, if I selected a term 20, I want to adjust my projection period to 20 years as well here. So once you have all your coverages, then now you can actually calculate what's going to be the premium required. So you're going to go to the right side because this is a universal life. It all depends on your plan design, right? So like you're going to go here, you're going to make sure it says personalized, and you're going to click modify. Now, before you click modify, you want to check your interest rate, and in most cases, you want to make sure that this is 4%. Why 4%? So 4% is due to something called stress testing. So when you go and calculate your premium, whatever interest rate you selected here, when the software makes the calculation, it's gonna assume that that's the average return that the policy is gonna produce. So you want to be very conservative with that number. We're gonna go over the investment funds here in a second, but in most cases you want to make sure that that's 4%, and that will allow you for the policy to be properly designed. Then you're going to click modify, and then you're going to select the type of premium. So type of premium, you're going to go and select quick payment. Quick payment will make the calculation based on how many years you tell the software. So here it tells you, right, it asks you from year 1 to how long you want to fund the policy. Let's say in this case, I want to fund the policy for 20 years, right? So I'm going to put 20. So what the software is going to calculate is how much payment has to go in for 20 years to properly fund this policy. So we're going to click calculate, and the software will work itself. So now if you see, it tells me that if I want premium payments for 20 years, at least there needs to be, 243.52 monthly deposit, right? So what you're gonna do is you're gonna now switch from quick payment to specified. Now you know your minimum. So you don't want to put anything less than that. You can put more, and that's okay. If you put more, it's just gonna add to the fund value. So I typically round this up, right? So like, let's say, you put 245, or, maybe you even want to put like 250. It really depends, on also case by case, right? So let's say we're gonna put 250. We're gonna click apply. So now I know that for this coverage, then we need $250, right? Now, next step is you're gonna go to the investment tab, and on the investment tab, you wanna select your fund allocation, right? So make sure, don't just leave the default, because in this case, IA has a default, it's this diversified fund, but it might not be the one you want to use, right? So what you're going to do is here on the bottom, it says add investment instruction. So if you click there, it's going to pull up all the options available that you can add, all the instructions of the funds. If you want to explore each of those funds or each of those options, you just click on learn more. And then you click there on that first link that says Genesis Info Series. And then here you're going to find all the information about the funds, right? So you're going to find the fund facts, right? So for example, this one was there, like that was like the default from IA, diversified IA account, right? And you can find, it's a low to moderate fund, right? And you can find all the details. So you want to go back here, and then you want to put your fund allocation. So in my case, I'm just going to select here, a few different funds. So let's say I'm going to select 4 different funds here, right? So I'm going to have a mix of these 4 different funds. And then you want to change, those interest rates, right? Depending on what you chose, right? So let's say in my case, all these funds are equity funds, right? So, I might choose, let's say 7%, right? If you had, let's say like a bond option, or you selected a guaranteed investment or something like that, and you don't want to put 7%, right? Because it would be unrealistic. But let's say in this case, it's full equity. I'm going to put 7%. And then in this case, I'm going to put how much percentage is going to go to each of these funds. So let's say in this case, let's say if it was like, 25% in each, at the end, I need to get a total of 100% here on allocation. And then here, if you had different rates here, then this would adjust and calculate an average return. In this case, because I put the same to all, it says 7%. Right? So now you have your investment portfolio, and then, that's all you need to do here. You don't need to touch anything else. And the last thing is going to be to produce your report, right? So in your report here, you can select, the sections you want. There's some that are required, so that's why they're already, in gray. But if you want some additional things, you can add them there. The most important here is on your customization years. I typically select all years, which means the illustration will show me all the years up to age 100, right? But if you want like a different design, then you can choose here, and then you can also choose which advisors to be listed in the illustration. Then you can also ask for a, compensation report, which will calculate the points that you're going to get paid. And also you can select medical requirements, and the illustration will tell you based on the client's age and face amount if there's any initial medical requirements that are a part of the application. So for the compensation report to be accurate, then you need to make sure that on your settings for your illustration, so if you go to the right hand corner here, you go to illustrations, that your compensation bonus is 165%. If this is not 165%, the compensation calculation is not going to be accurate. Also here, like, it's where you can decide what you want your province to be as default. So let's say you can select the province where you do the most business, right? So let's say if that was Ontario, if you're in Alberta, you might want to have Alberta, right? But then a compensation bonus, you want to make sure it's 165%, and now the software will calculate how many points you're going to get compensated for this plan. So we're going to click save. And once we have that, then now we can go to our report. We can click on generate report, and it's gonna produce an illustration. And it's gonna ask you to save the illustration. So make sure you save it in your client file, right, wherever you want to save it. And now we have an illustration. So see, now it says there, illustration prepared for Bart Simpson, prepared by Rafael Barrientos. It even has the date and time that it was prepared. So you want to scroll down and you want to make sure that everything looks like you want. So I'm going to explain you a few things here. So here has all the coverages, right? So it has your universal life, it has the term rider, it has the critical illness rider as well. It gives you also, some details about premium. So I'll explain a little briefly these ones. Minimum premium means the minimum amount that needs to go into the plan. Now, if a client were to pay only the minimum amount, they will be paying for the cost of insurance only. There will be no money going to the fund value. So you don't want to do that, especially not in this type of plan. Reference premium is the minimum premium recommended by the company. And also, it's the premium that is used to calculate how you will get compensated, right? And then you have maximum premium, which is the maximum premium that the client can deposit, into the policy for the fund value to be tax exempt. And then your selected premium, right? It's 250, which is this was based on the calculation that you make, right? So what the client is actually gonna pay, it's gonna be that $250. And then you can see here from year 1, 250, and then from year 21 and on, it's designed that there's no more premiums going in. Now, and then here is gonna have, like the funds, right? So in this case, it has all the funds that you selected, right? It tells you the average return based on what you put in the plan. Now, you want to check that this makes sense as well. So this interest rate sensitivity test gives you 3 different scenarios, right? So the basic scenario is based on the interest rate you selected. So in this case, 7%. So it tells you what's going to be the fund value at different stages based on that 7% rate of return. Then there's a favorable scenario that assumes 2% additional to your selected interest rate. So in this case would be 7 plus 2. This will be based on 9%. And then you have an unfavorable, which assumes 2% less than what you selected. So in this case, 7 minus 2%, it's 5. And your unfavorable scenario, you want to make sure that this policy doesn't lapse. Now, it shouldn't, because when we did our design, we did it at 4%. And in this case, this is assuming 5%, right? And then you can go to your illustration where it's gonna show you a projection of the premiums paid, accumulation fund, right, death benefit. And then you wanna make sure that this makes sense. So for example, in my case, we have planned premiums for 20 years, right? So $3,000 a year for 20 years. After that, we estimate that premiums can stop, right? And then it will give you a projection, at any given point, and you can see it goes till here, age 100. So that's it for the IA illustration.